Here's what no one tells you about having more than $5 million saved in your retirement accounts. It's not just as simple as just investing it, letting it ride, and hoping for the best. Hi, I'm Eric Rodriguez, certified financial planner and founder of Wealth Builders LLC. And today I'm going to be showing you how to take that $5 million plus portfolio and show you how to invest it in the smartest, most tax efficient way possible. Because if you think taxes, inefficiency, and poor planning aren't going to impact your wealth, you better think again. So today I'm going to be sharing some really good best practices on how you can implement some of these techniques in your own planning and portfolio investing. Here's the problem I typically see with pre-retirees or retirees. If they're approaching retirement with more than $5 million in their investment accounts, they've worked hard for that money and they feel like they've reached the finish line and there's no more work to be done. But matter of fact, more work has to be done from a planning perspective, because even with a $5 million plus portfolio, with that large amount, taxes and inefficiency can really chip away at your wealth if you're not careful. So in today's example, we're going to be using, someone having 50% of their wealth in taxable accounts and 50% of their wealth in traditional tax deferred accounts, AKA retirement accounts. That's a pretty common scenario is what I see. But if you have half your money in taxable accounts and half in your tax deferred accounts, typically what most people don't realize is how much tax they're paying on capital gains, on dividends, and even when they withdraw from those retirement accounts, they're not leveraging strategies that could help them save thousands, in some cases millions of dollars in taxes each year after year after year. Worse off, they're not adjusting their investments to take advantage of evidence-based strategies that are backed by decades of financial science. So this approach is missing the mark. If you're not paying attention, it could cost you a lot more than you think. Here's exactly how I would invest this $5 million plus portfolio for a client at Wealth Builders for maximum tax efficiency, growth, using an evidence-based strategy, as I mentioned, relying on decades of academic research and leveraging financial science. So let's say we have a $5 million portfolio. Again, half in the taxable accounts, half in tax deferred accounts to keep it simple. Keep in mind, this is an example, not specific advice for you. Every portfolio needs to be customized based on your specific risk profile, your time horizon, and goals. So this is just an idea of what it could look like for someone in this type of situation. We start with tax smart investment management. One of the most effective strategies here is tax loss harvesting. I did a whole video on this. I'll link it in the show notes below. But tax loss harvesting, this is where we sell investments that have declined in value to offset our taxable gains. What this does is it lowers your overall tax bill. So for example, if we have a stock or ETF that has underperformed, we might sell it in the taxable account and then use the loss to offset gains elsewhere in the portfolio. This is a proven way to reduce your tax liability year after year while still keeping your investments working for you. Next, we'll focus on consistent rebalancing. This is one of the most underrated aspects of portfolio management. Rebalancing is more than just adjusting for risk. It's about tax efficiency as well. So we'll automate the rebalancing process so that as the market fluctuates, your portfolio stays aligned with your specific financial goals and risk tolerance while keeping taxes in check. So what this process does is it helps ensure we're always optimizing the portfolio no matter how the market moves. When we make transitions, whether that's shifting investments between accounts or making sales, we'll do it tax smart. Instead of just selling the first investment we see, we're strategically selecting which assets to sell from taxable versus tax deferred accounts. So by doing this, we're minimizing taxes and we're keeping your portfolio growing as efficiently as possible. Next, we're gonna focus on the asset location optimization. So we also optimize asset location. So we place income generating assets like bonds in tax deferred accounts while putting high growth assets like stocks, ETFs, mutual funds, etc., in taxable or tax-free accounts. So what this does is this strategy is minimizing taxes by taking advantage of different tax treatments available for each account type. Next is tax lot selection when we're managing portfolio. This is another important strategy. So this allows us to choose the most tax efficient shares to sell, minimizing your tax burden by targeting long-term capital gains or shares with the least tax impact. So over time, this can make a significant difference in your overall returns. Then when it comes to the actual picking of funds and management of stocks and ETFs, index funds, etc., we're going to use what's called an evidence-based, or some people call it factor investment methodology. I did a video on this. I'll post it here below in the show notes about the 3 different investment styles. This is one of them. So this is exactly how we would construct the portfolio at my wealth management firm, Wealth Builders LLC. In terms of pure fundamentals, we believe when it comes to investing that less is more. We don't try to outsmart the market. We let the market work for us, and we focus on this evidence-based style of investing, which means we're going to be investing based on factors like company value, company size, the momentum, and the profitability of the organization. These factors have been researched and shown to deliver long-term results with less volatility. So, for example, in a $5 million portfolio, we'd invest in a low-cost, globally diversified equity portfolio that leans heavily into smaller cap stocks and value stocks, both of which have historically outperformed the market or over longer periods of time. We would also allocate a portion, depending on the client's risk tolerance, to fixed income assets in tax-deferred accounts, such as bonds, to keep your portfolio balanced and tax efficient. So we invest in these strategies because we believe markets generally work, costs matter, and risk is rewarded over the long run. So here's where the power of financial science comes into play. So according to recent research from Dimensional Fund Advisors, targeting these factors, so size of the company value, and profitability, can significantly improve retirement outcomes. So for example, many retirement investors, what they do is they simply track broad market indexes. Often through target date funds is typically the most common, S&P 500 index funds or something like that. But what Dimensional research shows is that this can leave money on the table, a significant amount. So investors who focus more on a core equity portfolio that emphasizes the size, value, and profitability premiums can see those higher expected returns with a much more controlled level of risk. Here's a striking statistic. So imagine we had 2 investors who contributed to their retirement accounts from ages 25 and 65. Both follow a conventional target date glide path. So what that means is they start with mostly equities and stocks, and they gradually shift to more of a 50-50 mix of stocks and bonds by age 65. So start off really aggressive and then tapering down as you get older to preserve your investments. So one investor uses a broad market portfolio, primarily of just basic index funds, while the other focuses on a core equity strategy with a slight tilt to the company size, value, and profitability. So what's striking is at age 65, the investor using the core equity portfolio typically has 15 to 20% more in assets than the one that followed just the basic indexing market approach. That can mean the difference between having $10 million and $15 million, just to put that in perspective, maybe even more. But by emphasizing size, value, and profitability, we can potentially improve your retirement outcome significantly simply by building a portfolio that taps into these premiums. But, and this is key, this is not something we can do without fully understanding your risk profile, time horizon, and goals. So every client has a unique situation, and then from there, we're gonna create and tailor a portfolio that best meets the client's needs, circumstances, and their desires. And another thing I wanna add too, when we think about global portfolio, we want a global portfolio with this $5 million plus, because we don't want concentration only in the United States, because we don't want to risk having all of our money perform negative or zero. Perfect recent example could be the years 2000 to 2010. If you would have had all your money with a US bias and only investing in the S&P 500 index fund, for example, you would have returned a flat 0% in a 10-year period. Again, that's called the lost decade. And a lot of it had to do with unforeseen circumstances. We had a terrorist attack, we had a housing crisis, we had the financial crisis, we had a controversial presidential election. There was a lot that went on between 2000 and 2010. But if you would have diversified the portfolio and had the global exposure, during that time, bonds delivered well over 5%. Also, international markets did a little over 6.5% during that 10-year period. So if you had international and emerging markets, you would have done quite well. Having, again, that global tilt as well is very, very important when it comes to market investing and portfolio construction. What can you do? First off, if you're serious about making sure that your $5 million plus portfolio works harder for you and doesn't get eaten up by taxes, it's time to get strategic. So in my opinion, and again, I'm biased, full transparency, but I believe you should be working with, when you have this type of money, these types of assets, you don't want to gamble it. So I believe you should be working with a certified financial planner like this guy who specializes in tax smart investing and evidence-based strategies. So at my firm, Wealth Builders LLC, we focus on creating personalized life-centric plans that help you secure your retirement without unnecessary tax burdens. So if this is a lot or you're feeling overwhelmed, if you're ready to take control of your retirement and ensure that your $5 million plus portfolio works for you, feel free to visit the site. You can go to wealthbllc.com and fill out the form. And if it makes sense, we'll schedule a free consultation and see if it makes sense for us to potentially work together and put plans together. Otherwise, there's also, if I can't help you, I can refer you to somebody that potentially can help you. Thanks a lot for watching this video today. I'm Eric Rodriguez. I'll see you in the next video where we'll dive in deeper into smart retirement strategies that can help you retire confidently. Don't forget to like, subscribe, and hit that bell for more tips on securing your financial future. This helps get the message across to other people just like you. So thanks again for watching, and I'll talk to you soon. Once again, it's Eric Rodriguez here. If you're looking to get help securing your financial future and you're serious about implementing a wealth plan for your specific situation, feel free to check out my website, wealthbllc.com, to learn more about how I work with clients, how I help them align their resources with their values, and put together a comprehensive plan to help them retire on their terms.